Okay, welcome to the last investment and business club meeting. Today, today since it's the last meeting, I'm gonna start out with the stock market game show. So basically, I'm gonna give you guys some multiple choice questions. And you guys can type your answer in the chat. Um, like the top three who types their answers like quickest and like the correct answers, will get points, and these points can add up, etc. And at the end of the game show, I will announce the winners of the game show. Then after the game show, we'll do some case studies with the David Swenson portfolio. We'll also do a really quick review of what we learned in 2023. So yeah, does anyone have any questions? Okay. So keep in mind that some of these questions are kind of hard. And you might not remember all of them, or sometimes like you might get the correct answer, but you're not in the top three. It doesn't matter that much. Okay, already an answer. Okay. What is the purpose of the 2-minute monologue mentioned in the text? Does anyone else have any answers? For each one I'll wait like 30 seconds. Okay, the correct answer is B, to communicate the reasons for interest in the stock quickly and clearly. Um, basically, as you might remember in the 2-minute monologue described in chapter 11, the sole purpose is to like tell someone or to tell yourself, why you're interested in the stock. So first place is Chloe, second place is Valencia, and third place is Alicia. Also keep in mind that sometimes like I guess like answers like 1 second or like half a second ahead of others. Even if you got the correct answer, but you're not in like top three or anything, it's okay. Because like the important thing to learn is to learn, right? And like sometimes all that matters is just like if you have if you have a really quick internet. Okay. The second question is number 2. What information will be crucial to know for a slow-growing company before buying the company stock? Like, which information would be really important? You can think about like why would buy a stock. Okay. Okay. The correct answer is C, the company's dividend yield in history. So first place was Chloe, second place was Evan, and third place was Alicia. Okay. Question number 3. What is the focus or what's important when considering a cyclical company in the 2-minute monologue? Okay. The correct answer is B, business conditions, inventories, and prices. So first place was Valencia, second place was Chloe, and third place was Evan. Also, I'm gonna starting from now, I'm gonna give you guys like slightly longer times to respond in case because some of the questions are kind of hard. For a stalwart, what key issues are highlighted in the 2-minute monologue? A, recent political developments. B, the number of offices globally. C, the P ratio, recent stock price movements, and factors accelerating growth. D, the CEO's hobbies, and E, the company's plans for rapid future expansion. Okay, the correct answer is C, the P ratio, recent stock price movements, and factors accelerating growth. Because stalwarts, they're like mediocre companies with like about like 10%, 15%, like 15% at the most. Um, like of course, um, so like when you're looking at a stalwart, you may want to look at the P ratio to see if it's overpriced or not, and to see if you can get a good bargain, recent stock price movements, and factors to accelerate growth. Of course, I can see why people would get E. It's also a pretty close option too. Um, the company's plans for rapid future expansion. But note that from this wasn't really mentioned in chapter 11, but in previous chapters, note that the author said that usually stalwarts are companies that were usually really fast with lots of future expansion and really rapid, but over time maybe they expanded too much, they can't expand more, or etc. But I guess E can also be correct in some scenarios. So thank you all for answering. Um, don't worry if you didn't get it correct or you answered too slow or anything. Because the important thing to like note is to learn and to try. So thank you all for answering. Again, thank you. Let's move on to the next question. Number 5. What aspect is crucial when considering a fast goer in the 2-minute monologue? A, the company's history. Yeah. A, the company's history. B, the number of employees. C, the company's plans for rapid future expansion. D, the company's competitors. E, the P ratio and recent stock price movements. Also, can you guys like also know that you can only make one decision starting from now on. So please, and also if you get the wrong one, please do not spam me with text messages because it is really hard to like sort through the text messages. So yeah. But anyways, it's okay because like And honestly, don't worry if you don't get it right. Um, because chances are you will get it right because usually these aren't as complicated as you might seem. And like if you get it wrong, don't panic that much. And like if you get it wrong, it doesn't actually matter. What matters is just trying. Um, and so far I have not gotten like three correct answers so far. Um, so I'll just keep on writing. Okay, the correct answer is C, the company's plans for rapid future expansion. I'll explain a little because I saw a lot of mixed answers. Because fast growers, they have like really rapid future expansion, right? They have really rapid growth and expansion. Um, and it's important, like it's crucial when you're considering a fast grower, like to look at like your plans to grow a lot more quickly, um, and to like look at their growth plans, so like their plans for rapid future expansion, because that's what really matters in a fast grower. So the answer is C. And again, thank you all for responding. And let's move on to the next question. For chapter 13, using the example of legs and Pampers, what is emphasized regarding the impact of a product on a company's stock? Uh, what happened?
Wait, Olivia, I just joined because I was like 10 minutes late. So are we supposed to be like on a document to answer or
Oh,
do we?
you can just type it in the chat. A lot of people have direct messaged me, so you can't really.
Oh, okay.
Okay, so um, the correct answer is A, to assess the contribution of a product to the company's total revenues. As the author mentioned, Pampers was a lot more profitable than the Lags, but Lags contributed more to the company's stock, while Pampers was only like 1%, like maybe not 1%, but it contributed very little. So it didn't make that much of an impact on a company's total revenue. So the like if you focus on one specific product of a company that makes a lot of different products, it's important to assess like how much of the total revenue of a pod like how much of the total contribution of the product is to the company's revenues. So first place was Daniel, second place was Chloe, um, and third place was Alicia. Also, Isabella, if you just arrived, I'm gonna go over the rules of the game show to you. Basically, um, we're doing a stock market game show, where I'll give you a few multiple choice questions, and you can type the answer you think is correct into the chat. I will pick the top three answers, who like the top three correct answers, who are the top three people who are the fastest to give me the correct answer. And they'll get points. And in the end, I will add up the total number of points to get the first place, second place, third place, etc. Um, yeah,
Okay, thank you.
no problem. Okay. Number two, according to the text, what does the author suggest about the relationship between the PE ratio and the earnings growth rate of a fairly priced company? Fine, you know what? I'll give you guys like a second chance for another correct answer. Because I'll wait like a few more seconds, and if I don't get like at least one more correct answer, I'll let you guys pick another correct answer. Like another answer. Okay, I'm just gonna announce the correct answers. Um, First place was Valencia, and yeah, first place was Valencia, and second place was Evan. Um, so the correct answer is C. The P ratio equals the earnings growth rate, because we're talking about a fairly priced company, right? Um, Not like an exceptionally priced company, but like a fairly priced company. And I think in the book on page 199, it said that like um a fairly priced company usually has a P ratio about it like around its earnings growth rate. Number and keep in mind that some of these questions are kind of hard, as I said before. So don't be discouraged if you didn't answer it correctly, because some like many of these questions are really hard. So yeah. Question number 3. In the context of P ratios and earnings growth rates, when might a company be considered a bargain? Okay, you know what? Actually, I thought about this question anymore. Sorry, just two correct answers. There's actually two correct answers to this question. Um, One is stated like the typical correct answer is stated in the book. But there's another correct answer that's like I guess kind of correct too. Yes. So I'm gonna count those two correct answers. Okay, so as I said before, just two correct answers. So first place was Chloe, second place was Valencia, and third place was Livia. So the correct answers are A and C. A is when the P ratio is half the growth rate that was stated in the book. And C is when the growth rate is higher than the P ratio. This is correct too, yes. It's not like what is stated in the book, but it when you think about it, it's correct too. Um, also, keep in mind I said earnings growth rate here. If I wasn't clear enough, there's a difference between the earnings growth rate and the growth rate, like and the growth. It's like the earnings growth rate is like how much the earnings are growing, while the normal growth is just like the earnings. Yeah. Number four, how can an investor calculate the company's earnings growth rate if the broker doesn't provide this information? I'm just gonna announce for the sake of the time, the two correct answers. Number one is Evan. Number two was Alicia. The correct answer was C, by calculating the percent increase in earnings from one year to next. Because you can think about it like this. You can calculate the company's earnings growth rate by just looking and calculating the percent increase in earnings from for like every 2 years. Um, uh, Number five, this one is kind of hard, so I'll give you guys a hint. The table below shows McDonald's earnings and dividend in the past years. According to the calculation method mentioned on page 199, would you want to buy its stocks by the end of 2023? I think it's June 30th. Yeah. Speaking of which, Daniel and Chloe, you guys gave me the answers first. So how did you guys find the answer? Fine, Chloe, do you want to share how you got it? Or actually, Daniel, do you want to share how you got your answers?
Wrong?
Huh?
Am I wrong? Is no wrong?
Not gonna tell you right now.
Well, I chose no because the P ratio was really high and it was greater than earnings per share. So, yeah.
Yeah, that's a really good way to look at it too. Yeah, you don't need to use the calculation method, but you can like tell, from the information given. Um, yeah, Daniel, do you wanna share?
Because the P ratio is pretty high while the earnings are a lot lower.
Yeah, that's really interesting too. That's like Chloe's take on it, right? Okay, Evan, do you want to share how you got the answer? No? It's a, hmm. Oh, it's okay if you don't want to share. Um, um, s- or so I'm just gonna continue with this. Um, Honestly, I would not buy McDonald's if I were like if I personally would not buy McDonald's. Of course, some people have varying opinions. Um, but according to the calculation method mentioned on page 199, Peter Lynch's calculation method was dividing the growth rate by the PE, like the growth rate plus the dividends by the PE. So we for like I'm gonna tell you guys how to calculate it, but I'm gonna flip it. So I divide the P by the growth rate. Because this I'm gonna like flip the calculation method or the formula. Um, because the P divided by the growth rate is actually how you can calculate the PG, which is like this pretty common like ratio, a little like the P ratio. But like it serves different purposes. Um, so basically, we need to find the earning growth rate and the dividend yields. So we can see the earnings growth rate using this formula. So that's 6.82, which is the original earnings per share, times like the average earnings growth rate over these 6 years. There's five like periods of time from 2018, 2019, 2019 to 2000 to 2020, etc. So I get this formula, which is 6.82 times the average earnings growth rate to the power of 5 equals 10.85, which is the earnings per share right now. Um, so R is like the rate it's growing by. So R is 9.73%, or we can find it by using that formula. The dividend yield, we find all the dividend yields and average them, which is 2.25%. And then we add them together to get 11.98%. Um, so then we divide this from the P. The P right now is 27.36. So we divide 27.36 by 11.98, which gives us 2.28. Note for the PG and for Peter Lynch's calculation method, they have different different rubrics to see if it's like poor, okay, or better. For Peter Lynch's calculation method, less than 1 was poor, 1.5 was okay, and greater than or equal to 2 is like really great. For the PEG, a poor PG is greater than 1. An okay PG, or like an average PG, is 2/3, and the good PG is less than 1/2. We can see from here we got 2.28, which is way more than 1. So we can see that according to the PGs, McDonald's may not be a very good stock. You can do this also with Peter Lynch's original calculation method. Um, but I'm just like telling you guys how to calculate a PG, which is kind of similar to his calculation method, just flipped. Does anyone have any questions so far? Or does anyone need me to repeat something? Because I might have like talked too fast. Anybody? So do you guys follow what I'm saying? Because this is a pretty hard question. It's okay if you have any questions. In fact, it's pretty good if you have any questions, actually. Okay. Now I'm gonna move on to question number 6, and I'm not gonna give question number 5 any points. Just because it's like kind of an open question actually. It's not really a game show question, it's more of an open question. Because this depends really. So question number 6, why does the author advise checking the cash position as part of research before buying stocks? Okay, the correct answer is D, to identify potential hidden rebates and assess the overall financial health of the company. So number 1 was Chloe, number 2 was Evan, and number 3 was Valencia. Okay. Question number 7. What's a quick way to determine the financial strength of a company? Okay, the correct answer is C. Number 1 was Chloe, number 2 was Daniel, and number 3 was Livia. Number 8, what's the normal ratio of the debt to equity ratio for a financially healthy company? And the book doesn't necessarily like state this, so you might need to like figure it out. My book will. Okay. Number one is Chloe and number two is Livia. The correct answer is A. The debt to equity ratio should be less than or equal to 1/3. As the book said, like the optimal like a good debt to equity ratio for a financially healthy company is like equity like around like the debt to equity ratio is about 25 to 75. Okay. Or like less. Okay, and this is a multiple choice answer. Well, not a multiple choice answer. So like, there's multiple choices for this. There's like more than one answers for this question. So I'm only gonna count it if you say both. When checking a specific kind of company, the debt should be paid special attention. What kind of companies are they?
Are we allowed to use our book?
Sure. Williams? Oh yeah, to clarify, when I mean special attention, I mean like the most important attention, like the most attention, or like the depth. Or when checking a specific kind of company, the depth is like a really critical thing you need to pay attention to. Cause like yes, with like all stocks you need to pay attention to depth. But I mean like and which stocks are like the depth like really, 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 really important. Okay, fine. I'll give you guys one last hint. There's only two correct answers. I'm gonna count down to 30 seconds because we might be running a little bit out of time. Yeah, I'll skip some questions after this. Okay, fine. The correct answers are B and G, turnarounds and depressed companies. So Valencia was the only one who got that correct. Um, um, but you know, for turnarounds, that is really important because if they have a lot of debt, because turnarounds are like companies that were almost bankrupt or maybe bankrupt, but then they were revived. With turnarounds, debt is really, 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 really important. Because if a company is a turnaround, they can't have that much debt, and they can't have like that much bank. Like they can't have like a certain type of debt. Um, with depressed companies, it's the same. If they have too much debt, they'll probably go bankrupt. And if a turnaround has a lot of debt, they might not, or it's really risky for them to actually turn around, and then it might not even turn around. So, according to text, what is emphasized as a crucial factor in distinguishing winners from losers in a crisis? I'm gonna give you guys 20 seconds for this. Okay. The correct answer is C. The type of depth in its mount. So number one is Daniel, number two is Chloe, and number three is Valencia. Okay. And wait, I'm gonna skip some of these, but anyways, according to number 11? What distinguishes bank debt from funded debt according to the text? Oh wait, hold on. Okay. The correct answer is C, the due date of the debt. So number one is Chloe, number two is Daniel, and number three is Alicia. Because with bank debt, just like to explain this more, with bank debt, the bankers like when if they panic, um, they can like distinguish bank debt, from um. So when they panic, and they loan you money, they can like call back the money and like they can call you to say they need the original money you borrowed or the original principal, um, for the for the loan. And if you can't repay it like just then, they can like shut down the company. With funded debt, as long as you're paying the interest, they can't just ask you to give them all of the original money you loaned. Um, so funded debt is slightly less risky than bank debt because with bank debt, the bank can demand the money like off the money you originally loaned, like you originally like loan from the bank. But with funded debt, they can't like demand the original principal as long as you're paying the interest, right? Like the interest rates. Um, yeah. Okay. Question number 15. In what form does funded debt usually exist? Okay, the correct answer is C. So number 1 was Chloe, number 2 was Valencia, and number 3 was Livia. So question number 16, this one also has like a few, like more than one correct answers. Why are people in favor of companies that pay dividends? Like, well, why do people like companies that pay dividends? And you have got to tell me all of the correct answers, or else I won't count it. Like, you have to tell me at once, like in one text. Like, for example, I know E and F, even though there's no E and F. Like, you have to type it to me at once. Oh, and there may be like any amount of like correct answers. So there may be 2, there may be 3, there may be all 4. Okay, so the correct answers are A, B, and C. Desire for extra income, like when they're not paying dividends, they have a history of misallocating funds, and they can help stabilize stock prices. So you know what? Since we're running out of time, I'll skip some of these. Let's move on to the case study and the David Swenson portfolio review. So I'm gonna like paste the links in the chat. Can you guys like can you guys like go onto the spreadsheets? Well, actually, good idea. I'm just gonna like show it to you guys. So here are the people who participated in the David Swenson portfolio. If your name isn't on it, that may mean that um like like your total amount doesn't add up to 100%. So basically, here's the David Swenson portfolio through all of these months: July, August, September, November, and what? July, August, September, October, and November. Sorry, I said that wrong. As you can see here, through these 3 months, mostly everybody's portfolio was losing money because these 3 months were pretty bad months for the stock market. And 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 I know some of you may lose some money because, as I said before, these are pretty bad months. But here's a comparison of David Swenson portfolio to Olivia's, Aurora's, Isabella's, Elisa's, Evan's, Kristen's, and Kai's, and the S&P 500. Here is the total return for all of those months and the max drawdown. So as you can see here, here are the total returns. You can look for your name in this list and others. I'm just gonna ask, so as you can see here, Olivia's had a relatively good performance. The max drawdown was only negative 0.25%, and the total return was 7.11%, which is better than the SP 500 index and some of the others, as well as David Swenson portfolio. So can I ask Olivia to share about her portfolio and so
Wait, what?
wait, did I? Wait, am I muted? Okay, did you guys hear anything I said?
No.
No.
Okay.
Yes,
Wait, so when was I mute? Like, what did I say last?
you said, can Livia share about her portfolio?
Then why am I muted now? Or why was I just muted? Okay. Okay. Anyways, you know what? Actually, as a matter of fact, I was just asking you guys to go onto the spreadsheet. I'll paste the link in the chat, and you guys can compare portfolios. Like compare the portfolios. You know what? Actually, I don't think we have time for that. Okay. So as you can see here, wait, Livia, do you want to share your portfolio?
I guess. So there was just this one, I forgot what it was called, but I made a lot from that, and that's mostly what gave me positive returns and a 7.11% in total.
Mm,
It wasn't
cool.
really that much to it.
Wait, really? That's really interesting. Do you remember which one it was?
I don't remember, but yeah.
Okay. So basically here is the David Johnson portfolio here. As you can see, the allocations. And this is Lydia's portfolio. Sorry, I pasted yours here. And this is an overall chart of the David Johnson portfolio, the Vanguard 500 index, and Lydia's. So do you guys want to point out which one is different? Okay. As you can see here, Livia's had QQQ instead of VTSMX. She had FSPSX instead of VGSIX. XMXC, XLRE, TOT, and PFIX. Okay, so now let's move. Oh yeah, by the way, keep in mind that if your portfolio didn't perform that well or anything, it's okay because this is just over a few months and this is a really short period of time. Your portfolio may outperform maybe the David Johnson portfolio or like others over the long term because this is only a few months. You can't actually tell anything much from this. And this is just from a few months, like to see for fun, the portfolios. And don't worry if your portfolio had a negative overall growth or anything. You see, even the David Johnson portfolio had a negative, had like a decrease, had some losses. And what really matters for stocks is like the long-term gains and the long-term earnings. Okay, so now let's do a review of what we learned in 2023. Here are all the books we read. This many books, for example, The Millionaire Next Door, Rich Dad Poor Dad. Do you guys remember that one? I Will Teach You to Be Rich, etc. There's also personal finance. Oh yeah, and we also learned personal finance. We did some like we invested in some stocks mostly, and we learned about saving accounts, checking accounts, investment accounts, 401ks, both RIAs. We did conscious spending plans in the 60% solutions and various concepts like compound, the 72 rule, etc. We also did a lot of we learned a lot about stock investing overall. For example, RFDs, fundamental and technical analysis stuff. We did lots of case studies, lab activities, computer simulations. And overall, we did a lot. So thank you for your time in this investment club. I think this is the last meeting we have in 2023 or like in this year. So overall, thank you so much for attending these meetings and like sharing. And again, thank you for your time. Does anyone have any questions? Okay, does anyone have any questions? No, it's okay if you have any questions. Okay, so overall, thank you for your time. I guess this concludes the end of our meeting. Um, I'm just gonna stay here, but yeah. Bye.
Thank you.
Bye.
Thank you. Bye.
Cookie.